I was very bullish for how successful these Bitcoin ETFs would be, but I've been blown away. It's not going to be a traditional alt season. It's going to be this everything season. Bitcoin's going to punch above $100,000.
Hi there, this is Laurent. I'm the co-host of Verified, the brand new podcast by Bitcoin Suisse. But this isn't just any podcast. It's your backstage pass into the crypto world. My co-host Dominic and I are analysts in the crypto industry, where it is our job to stay on top of the latest market and crypto developments. None of the discussed is financial advice, of course. It's all for informational and entertainment purposes only.
Welcome back to Verified. We are super thrilled to have Matt Hougan with us, who's the Chief Investment Officer at Bitwise Asset Management. Matt's expertise centers around sound investment acumen combined with a deep understanding of global macro trends and also the intricacies of the crypto markets. Most importantly, Matt and Bitwise have been instrumental in driving institutional adoption of digital assets. And what I wanted to mention, head tip for the Bitwise commercials, quote unquote, you know what's interesting these days? Bitcoin. I loved your appearance. Very nice.
It's great to be with you all. And of course, Bitcoin Suisse is such a legendary organization. So I'm honored to be here and talk about Bitcoin. Yeah, the commercial was amazing. I'm not an actor, but they managed to get a take that worked. So this is a serious business that we're in, but that doesn't mean that we can't have fun along the way.
True.
No. Awesome. Matt, thank you so much for joining us today. We're really excited to hear your insights on the current state of institutional digital assets, the adoption, and where the future focus for investors might be, even beyond the established giant that is Bitcoin. Perhaps you could kick things off by sharing a bit about your background and what drew you to the world of digital assets.
Sure, absolutely. So yeah, great to be here, Laurent, as well. I'm the Chief Investment Officer at Bitwise Asset Management. Bitwise, of course, is a specialist crypto asset manager that have been in the market since 2017. Best known maybe for creating the world's first crypto index fund, the Bitwise 10. But now, of course, maybe that is overshadowed by our Bitcoin ETF, BITB, which launched in January and is now up north of $2 billion of assets. We do serve primarily financial professionals, so investment advisors, family offices, institutions, etc. So that is the market that I know. Before joining Bitwise, I spent 15 years in the ETF industry. So I was the CEO of ETF.com. I created the first ETF data service, the first ETF analytics service. I grew that business for 15 years before selling it and then moving over to Bitwise. The question of what drew me to crypto has a couple of answers, but maybe the most interesting one, and the one that people don't know, is in the early days of ETFs, people hated them. ETFs were almost a financial technology, a new way of wrapping investment that from my point of view were lower cost, more efficient, more fair, more tax fair, better for investors, more transparent. A lot of things that you would say sound very similar to crypto. But in the early days, the industry hated them. People don't remember this, but actually the Financial Times called ETFs weapons of mass destruction. The US Congress held congressional hearings about whether ETFs were destroying the American dream and killing American entrepreneurialism. And my experience in ETFs was that in the end, the technology wins. So if you have a better, fairer, faster, more transparent, more efficient mechanism, it doesn't matter that people are skeptical. It doesn't matter that they don't understand. It doesn't matter that there's FUD. There's a huge amount of ETF FUD. That technology will win out in the end, and it's a great place to bet your career on something that you know is going to be systematically important, but most people are skeptical of. That's a huge amount of alpha. So when I looked around after ETFs for what is the next big area where I thought massive implications for how global finance can work, but a lot of skepticism out there and a lot of poor understanding, that was crypto. So it's an even better opportunity than ETFs. ETFs were a great opportunity. And it was for certain the place I wanted to build the next phase of my career. And it's been a phenomenal decision. And for what it's worth, I was very convicted that crypto was important when I joined Bitwise in early 2018. And I'm 10x more confident now. It's been a phenomenal run. So that's my background.
What a great entry into this conversation. It's really impressive on how many parallels you see and that we see to crypto right now. Basically, all of us are in there to have this more efficient, more inclusive, financial system, maybe with less intermediaries even. I want to kick off today's episode by revisiting the resounding success of BTC Spot ETFs. Also, congrats to your successful launch as well. So Bitcoin, as you know, smashed expectations by margins, bringing like 12 billion by now in inflows in only a couple of months and 180 billion in volume. And with it, basically, Bitcoin became the fastest growing ETF sector. If you look at the top 30 ETFs ranked by assets after 50 days of trading, 4 BTC ETFs are in this list. And Fidelity and BlackRock are leading this list by a substantial margin, which is like super impressive. And recently you framed the approval of the ETFs as Bitcoin's IPO moment. So in your opinion, are we truly witnessing this institutional shift? And how do you experience this super overwhelming demand at Bitwise currently?
Yeah, it's been amazing to see the demand. I was very bullish for how successful these Bitcoin ETFs would be, but I've been blown away. As you mentioned, 4 are among the top 30 fastest growing ETFs globally. Our ETF from little Bitwise, right, a relatively small company in the space, is growing faster than the first gold ETF grew, to put that in context. And we're one of 10 different providers, right? And so there just has been enormous pent-up demand. When you get to the question of, are we seeing the dawn of institutional adoption? The answer is absolutely yes, but it's still extremely early. So I do think this is Bitcoin's IPO, at least in the US. If you think about the first 15 years of Bitcoin, it was really driven by retail investors and self-directed investors. There were, of course, institutional players in it. Bitwise built a business serving those for 6 years, and we accumulated $1 billion of assets, and we served thousands of clients. But the vast majority of people simply couldn't access this ETF. And now, through the advent of the ETF, they're starting to be able to. And the important thing for people to remember about that, which is both obvious but overlooked, is that the professional investors control most of the money. We talk about retail investors, and they're extremely important, and they were early to this class. They front ran the institutions, but at least in the US, they represent about 20% of the wealth. So 80% of the wealth couldn't access Bitcoin until January 11th. And that's the scale that we're talking about. Now, the last thing I said, and then I'll pause, I think we're still extremely early. Because when an ETF launches in the US, it's not immediately available to everyone. There's certain people who can buy it, registered financial advisors, which you may call IFAs in Europe, hedge funds, venture capital funds, individuals. But the biggest wealth platforms, things like Morgan Stanley or UBS or Wells Fargo, and there are 100 of these platforms, they actually have to do their own approval. So it's kind of like, like a nuclear key. You need to turn 2 keys in order for it to happen. And right now we've turned 1 key, and we're starting to turn the other key. But I would say the market's only about 20 to 30% open. It's going to open the other way over the next 12 months. And so I've been really pleased by these flows, but I also think we haven't really seen the full force of this market. I think things will continue to ramp from here.
Nice. I think that really tells us a lot. The recent surge in institutional inflows towards Bitcoin is beyond impressive. But after some days, we do have some sort of negative outflows as well. So yesterday's allocations rebounded with strength, accounting roughly for about 418 million net inflows, while GBTC outflows remained rather substantial. So at this point, do GBTC outflows start to taper off and stabilize, given the comparatively high fees, which may be accounting for those high flows? And how does Bitwise position itself, given the full price war that we're currently experiencing?
Yeah, absolutely. Great questions, Laurent. I'd say there are 2 types of outflows from GBTC. So one type is investors moving from GBTC to products like BITB because it's lower cost. GBTC charges 1.5%. Our ETF charges 20 basis points, so 0.20%. BlackRock charges 0.25% for the same exposure. And there are very few people who are willing to pay 6x the price for the same thing. So some of that money is just going to flow to lower cost. And I suspect that will continue for a while. But there's also inorganic sellers. Many of the estates that went bankrupt in 2022 held large amounts of GBTC because they were trying to profit on the premium discount arbitrage trade. FTX notably sold out of its GBTC position in the first few weeks after the launch. And many people think some of the outflows we're seeing now are related to the Genesis distributions that go on in the market. I raise that because at some point, those inorganic sellers will stop. And so I expect the outflows to attenuate significantly. And that'll be positive for the Bitcoin market because those aren't investors making a decision. Those are bankruptcy estates that are forced to sell and go to cash, right? So that's the market's going to improve over time. I do think we'll still see money flow to lower cost exposures because investors keep more if they spend less. At Bitwise, what we were trying to do was offer the most effective fee we could for investors. We had a number of advantages there. We already had an existing ecosystem. I didn't need to hire traders when we launched an ETF. I didn't need to hire a sales team. I didn't need to hire a research team. All of those costs were already part of the Bitwise infrastructure. So we were able to come out on day one with the lowest cost ETF at 20 basis points. And I think it's a phenomenal fee. And we're excited that even while having that lowest cost, we're still able to donate 10% of our net profits to Bitcoin core developers and support the ecosystem. Look, it's hard for Bitwise to win against BlackRock. BlackRock's a big name. So we need to stack all the advantages we can, and being the low cost provider or one of the low cost providers is one of those things that we can do.
Yeah, very nice. Also, chapeau to the donation part to Bitcoin devs. It's really nice to see that from entities such as Bitwise. And I would like to stick with these flows because there's one more component. On the one hand, we have these outflows, but on the other hand, the newborn nines remained like net positive. So while some component is from GBTC outflows migrating into the others probably, do you think we could also derive that these flows also indicate portfolio allocations already? Do you think that this is like a true new influx of money and institutional capital, basically? And how sustainable is it, in your opinion?
Yeah, absolutely. We're seeing allocations from professional investors that is net new money that didn't buy it before. Immediately before this podcast, I was having a conference call with an advisor who's establishing a 2% investment across all his clients into crypto. Last night at dinner, I had a dinner with an advisor, a registered investment advisor who has multiple portfolios with different levels of risk that ramps up the Bitcoin allocation to, I believe it was 10% for the riskiest allocation down to 1% for more conservative. And we're seeing these wins every day at Bitwise. And I imagine they're seeing similar wins at BlackRock and others. So this is the sort of dawn of institutional investment. And I love what you pointed out, that we saw these inflows when the market went down. We saw these inflows when the market went up. The thing that's different about these professional investors who are making this allocation is they're maybe less price sensitive than traditional retail investors. They're taking a multi-year view on an asset that has no correlation to stocks or bonds, or low correlations to stocks or bonds, that is liquid, that they can rebalance. And they're going to build a 2% or 3% or 5% sleeve, whether Bitcoin's at 40, 50, 70, or $100,000, right? They're going to build that allocation over time, and then they're going to rebalance it every year. And maybe as more money comes into their practice, they'll keep allocating into that space. They're not as hung up on the price. In fact, many of them probably aren't even looking at the price. To them, the price of Bitcoin is $39 because that's what's the share price of BITB. It's not $70,000. That is what they're looking at. So I do think it's a different kind of investor. And yeah, every single day we're seeing them come in, and not just registered investment advisors. We have hedge funds that are allocating through BITB. We recently brought in our first corporate investor who is putting Bitcoin on their balance sheet through an ETF. And all of these markets are going to continue to do this. And they're going to do it at 1, 2, 3, 5% allocations consistently year by year over time.
Nice. I think that's interesting. That kind of leads me on to the next obvious question, which is, what is the time horizon with regards to that? Because if it's the second key that's going to start turning, do we start to see even larger entities like pension funds and sovereigns even coming on board and saying, look, maybe is this really something that we should start considering? Maybe not as a reserve asset, but it's something that we should at least start considering investing in.
Yeah.
Just roughly, maybe some insights from your roadshow would be interesting too.
Yeah, that's right. Yeah, I've been on the road for 20 days talking to everyone. This is my last day. So if I look a little tired, that's why. What you're going to see, I believe, over a series of probably it will take 3 years, is institutional investors incorporating this as a normalized asset within their market. I'll make an analogy back to gold because I mentioned, our ETF is actually growing faster than the first gold ETF. But the first gold ETF is informative because it did something similar, which is it took an asset that institutions couldn't buy and brought it into a package that they were familiar with and brought it into the mainstream. And I raise this because people got excited about the gold ETF because it had a great first year. It was the fastest growing ETF ever over its first couple of days. But what they forget is actually inflows built. Every year 2 was bigger than year 1. Year 3 was bigger than year 2. Year 4 was bigger than year 3, on up through year 7. So for 7 years, it followed this staircase as more and more of these institutions unlocked, registered investment advisor, major wirehouse platforms, corporations, sovereigns, etc., institutions. And we're going to see the same thing over Bitcoin. I suspect that it'll be more compressed. I don't think it will take 7 years until the market is fully open, but institutional investors do move at a different speed than crypto. So I do think it could take 3 years until we have the largest institutions fully get their hands around that. But I suspect that the flows are going to build. I suspect 2025 flows will exceed 2024, and possibly 2026 will exceed 2025. I think it's going to, all my ETF history tells me that this will build for multiple years.
Wow. So we keep chasing record after record, I guess.
Yes.
What a pleasant outlook, to be honest, especially for everybody who has exposure. And also since, like you outlined, these are like very capital-heavy entities that did not join yet. So from these capital-heavy entities, it only basically needs a rather small relative allocation to move the needle. That's super interesting. I want to stick a little bit with the portfolio allocation aspect because I thought about it a lot and I crunched some numbers. And I would like to talk to you about something I would call the rebalancing effect of portfolios. Because as you know, probably way better than me, if the market goes up, basically, if we deal with portfolio allocation, rebalance out and vice versa. So this, in my opinion, should, if we also look at how much supply is migrating into these ETF vehicles, it's now like $70 billion or roughly 5%. And if we annualize the recent flows, we will end up around like 9% of the entire BTC market capitalization being in these ETFs. So now if we look at these kind of portfolio allocation, do you think it's possible that these allocations and the rebalancing mechanism will have kind of a cushioning effect on volatility? Or how will it impact the Bitcoin market basically? Especially since in the last couple of years, we already see diminishing spikes in volatility. Maybe does this even accelerate this effect?
100%. Yeah, it's a great point, Dominic. And I've been thinking about this a lot. One thing that separates these professional investors from many retail investors is that they do rebalance, sometimes quarterly, sometimes annually, but they have these targets. I want 2.5% Bitcoin. And if Bitcoin 4x's during the year, at the end of the year, they're more like 10% Bitcoin. So they have to sell. If it drops, they have to buy. And you're absolutely right. This should further drive down the volatility. Now, importantly, it drives down both sides of the volatility. So Bitcoin investors shouldn't get so excited, right? If Bitcoin rips, they're going to be selling. If Bitcoin falls, they're going to be buying. So it's not a free up only lunch. It compresses it on both sides. But I do think it'll contribute to a reduction in volatility in the Bitcoin market over time, and that will build over time. I would also add, vis-a-vis these short-term spikes, the other thing that these ETFs do is that they bring more institutional capital into the market. And part of what drives those short-term spikes is, liquidations of levered positions that are short-term moves, but there's not enough institutional capital to step in and support that. So I think that is also going to truncate that volatility. This is a more professional market with new types of investors that do different things like rebalancing, that have more capital to cushion that volatility. So I think we're going to see volatility drop. It's still going to be a volatile asset for sure, right? It's not going to be like short-term treasuries or something, but I do think we'll see a reduction in volatility versus what we've seen in the past.
Okay, thank God. I like volatility, to be honest.
I do too. I do too. Yeah.
Yeah. Let's spend a little bit more time with portfolios. As you know, Bitcoin has historically outperformed a lot of other major asset classes across many time frames. You can take 7 years, 6 years, basically pick whatever you want, and usually Bitcoin outperforms. Also, year-to-date metrics speak for themselves. Like we are now at 62% year-to-date, while the S&P is at 9% or something, gold at 5%. Only Nvidia, one of the isolated stocks, managed to outperform Bitcoin. So basically, the appeal of digital assets for these new joiners, I'd say, is very strong and is trending as they really amplify diversified portfolios, as you mentioned before. And we also spun up some model portfolios, and we saw that you see the largest marginal impact on a relative basis at rather low allocations between 1 or 2.5%. And if you want to minimize for volatility, fair, keep your 1 or 2% allocation. But if you want to max out on Sharp, for example, basically your return per unit of risk, you can go up to 10%. I think you mentioned that already. I would like to get your take on how does Bitwise or you quantify for an optimal allocation within such a common traditional, let's say, balanced portfolio framework? And are there any, let's say, fancy specific risk return models you recommend for determining this optimal weight?
Yeah, great question. We love these studies. They're really important to get out in the world. It forces people to evaluate this asset as an asset, removing the overhead of the name Bitcoin or crypto, which I think scares some people away. And what you see is it's a phenomenal contributor to portfolio returns, just like you said, Dominic, at even very small sizes. We're roughly in that same band. I would add, we see most of our investors do between 1 and 5%. And there's actually one interesting thing that happens at 5% that for me makes it sort of the cap for normal investors. I personally, way more than 5%, scarily more. But for many investors, something interesting happens at 5%, which is even though the Sharpe ratio keeps increasing up towards 10 and even beyond, once you get above 5%, Bitcoin becomes the primary driver of the maximum drawdown in your portfolio. So below 5%, the volatility in equities at a big portion of your portfolio is what drives the biggest drops in your overall portfolio value. But once you get above 5%, Bitcoin becomes the catalyst for that pullback. And I think that's an important factor because one of the biggest risks in crypto investing is behavioral risk. It's panicking, right? It's selling at the wrong time, it's buying at the wrong time. And I like that 5% number because maximum drawdown is what you feel in your gut, right? That's when you look at your retirement account or your taxable account and you're like, wow, it's down a lot. And so I worry about people panicking. And as a result, I think that's a nice dividing line for traditional investors. And you can have a huge impact on a portfolio at 5%, right? Historically, that's had a massive impact. So that's the only other sort of CAPM style statistic I would throw in there for you is that max drawdown effect above 5%.
Nice. I think that's very interesting, specifically with regards to allocation. I'm curious, where does crypto or Bitcoin, in this case with the ETF, where does it take allocation away from? So is it stocks or is it bonds in the traditional 60-40 sense?
Great question. For people who have an alternative sleeve, and a number of institutional investors have a bespoke alternative sleeve, we often see them drawing crypto from that. It may have been invested in gold or venture capital or private markets because it has such low correlation. The other place that we see it taken almost the majority of the time is straight from the equity portfolio. So even though it maybe is a non-correlated asset, people consider it a risk asset, and so they draw down from the equity side of their portfolio. And I think those are both good answers. It's a good equity replacement. Maybe if you have a technology sleeve, you could argue it goes in that area. But that's what we see from our investors is one of those two places.
Now that's interesting. I'm wondering if you now had to, say, benchmark your portfolio and your overall performance. Let's say even if it was a crypto-only portfolio, how would you, or where do you go to find the best, most suitable benchmark for a crypto index, for which there are a number at this point? But
Yeah.
is there anything that you fancy in particular?
Well, we like our own index. We built an index called the Bitwise 10. I think it's a robust institutional benchmark. What I like about it is that it screens out assets that we think institutional investors, at least in the US, have a hard time holding, which is not true globally. I don't think it'd be a good benchmark globally because you have more options, for instance, in Switzerland of assets that are acceptable or accessible to institutions than we do here in the US. So for US investors, we think our index is a good example, but there are actually increasingly a large number of high quality indexes. I think the important thing is that we're not a mature enough market that you can just go to coinmarketcap.com and take the 20 largest assets and weight them and get an investable benchmark. You need more rules around that. We have a lot of screens, but other people do as well. So in the US, I would say our index globally, I don't know, there are a number of high quality products out there, MSCI, FTSE, market vectors, et cetera, that we think are valuable.
No, that's so true. And this is definitely a thesis that I follow as well. I completely agree that you cannot go to the market cap and just say, I'll wait as per market cap. If you look historically, there's been some interesting tokens that have been that are no longer around, that are now featured in the top 20, for example. And you really have to peer through, I think, looking at more on-chain activity, for example, to figure out, okay, maybe this is something that requires a little bit more of a fundamental analysis, or maybe even looking at a taxonomy, which then helps you at least get some sector diversification. But one of the areas where, we've also put a lot of work in is looking at smart beta indices, for example, and a little bit something more sophisticated. How do you see these index products taking over into the future? You have Vanguard ETF, you have the S&P 500 as benchmark indices. How do you see indices evolving in crypto and onto the markets, assuming that we have at least quite a number of assets on exchanges?
Yeah, 100%. I think there is going to be a huge growth in indexes in two different directions. So beyond what we have today, which are essentially large cap indexes, I think you're going to see a real growth in sector or theme indexes. And many people who start with Bitcoin or start with a large cap index will then decide they want only DeFi, or they want only layer ones, or they're interested in the layer two space, or they're interested in gaming applications, et cetera. There's some really interesting work there. I love the idea and would love to spend some time with your research on the smart beta front, because I also think that is an enormously exciting area. To start with the most obvious factor, it's shocking to me that there isn't more interest in momentum factors within the crypto market. Of course, there's momentum in the crypto market. There's probably more momentum. The factor is stronger than it is in other markets. And it's one of the most proven factors in history from an investment perspective. So I think that's obvious. But there are also like non-traditional factors that I think would be very interesting to investigate, sort of RAFI style fundamental factors tied to users, revenues, fee, developer activity, et cetera, that maybe don't map one for one from traditional finance, but are inspired by that sort of fundamental indexing idea that has a lot of credence in the US. And I think we're going to see that in short order. So I'm very bullish on the index space, both for benchmarking purposes and for investment purposes. I think it's going to be a huge space. One last comment. We run a crypto index fund. It's about $1 billion. It's one of the largest in the world. That's ridiculous. This is a $1.5 trillion space. Index funds should be 20, 30% of this market. $1 billion should be small. I'm not just saying for me, I'm saying globally. I think there's $100 billion in index flows that's going to happen over the next few years, just because it's such a valid way to approach the market. And it's still surprising to me that it's so small, but I think that's changing and is going to change rapidly.
$1 billion is small. I'll take it though.
Oh yeah, for sure.
1,000 million.
100%. I just mean that we have a long way to run, for sure.
Of course.
I think we are like great insights, Matt, and I think both of us are on the same page, and also from Bitcoin Suisse overall. We now covered Bitcoin and the ETFs extensively, and I would like to shift focus a little bit on the next customer in line, which is Ethereum, right? Unfortunately, currently the odds of approval in May are kind of dwindling. I know Bloomberg analysts project like 25%. Prediction markets, which are very cool by the way, are at like 24%. And I also checked today, the discount to net asset value has also increased now and is up to 22% again. So maybe an interesting opportunity, I don't know. On top of that, the SEC also appears to be on a mission to challenge ETH's regulatory status from commodity to security. I bet you followed that discussion. And compared to the BTC timeline, like basically on top of all of these negative metrics, there are also no comments or preparing from the SEC side. And there's only 60 days left to the deadline. Because interestingly, the SEC started engaging more than 90 days prior to the Bitcoin deadline. So what I'm trying to say is overall hopes are fading that we see a green light. And you recently stated, quote unquote, we need another 8 or 9 months of digesting Bitcoin first. So I would like to get your take on what are the potential benefits of a delay in your opinion? And how might it impact Ethereum's perception compared to Bitcoin? And also, do you agree with the odds that I just outlined?
I love it. Yeah, I agree with your odds. I also like how you framed it. Those are 3 great independent data points: the Bloomberg odds, the poly market or prediction market odds, and the ET discount. What a phenomenal way to view it. I think they're probably accurate, right? Usually at this stage, you see back and forth between the SEC and issuers, updating the prospectus and answering questions. These are complex documents. They're hundreds of pages long, and you have to get them just right before you launch. So it is an iterative process and a process that takes time. And, lawyers only work so much. So that's, I think, why people are getting worried about May. I do think it will happen eventually. I'm not scared off by the SEC's sort of probe into ETH security status. If you've operated in crypto for a long time, you know that the SEC is always probing everything. And that doesn't necessarily mean there's an enforcement action coming or that they have a particular view. They may just be investigating something. So I don't put too much stock into that, particularly given the strong arguments in favor of Ethereum not being a security and the historical precedent and the CFTC's strong statement that it is a traditional commodity. So I think we'll get it eventually. I'm skeptical we'll get it in May. And as you mentioned, I think that will be better for the market. The reason it will be better for the market is we're still having conversations around Bitcoin. They haven't even approved them on major wealth platforms. I'm still going to financial advisors, and the 100 Matt Hougans at other firms are still going to financial advisors and talking to them about Bitcoin. It complicates the conversation to have this secondary comment. I don't know what a good analogy is. It's like asking someone what they want for breakfast. If they want breakfast and they say yes, versus giving them a menu with 20 things on it, and then they don't know if they want eggs or waffles, and it gets confusing. I think people will be confused by that. So I think if the market has another 9 months to digest Bitcoin, if it get approved on major wealth platforms, if they get comfortable with custody, if they get comfortable with liquidity, if it's gone through the due diligence sequence, if people have had 9 months of experience or a year of experience owning Bitcoin ETFs, then they'll be ready for Ethereum and the flows will be significant. I think if it launches in May, the flows will be limited. I would just suggest to people in the audience, many people came into crypto through Bitcoin. I know I did. And imagine if you had just read the white paper and then the next day you read the Ethereum white paper and then someone was like, oh, but Solana. And they're like, oh, this is new thing, Aptos and Say, and your mind just exploded. You still needed time to get your hands around Bitcoin before you were ready for something else. So I think we'll have larger flows into both Bitcoin and Ethereum ETFs if we're approved 9, 12, 15 months from now. And I think that's what is going to happen.
Yeah, great take. And also a good primer for my next questions. So the first one would be, you touched it a little bit. Also, obviously, I agree at some point the ETH Spot ETF will happen. But from a perception perspective, do you think it's easier to understand Bitcoin with its store of value digital gold, basically narrative? Or do you think it's easier for, let's say, boomers to understand ETH as a deflationary cash flow asset? And then two more very brief questions. When, if you can share something with us, when Bitwise application for spot ETH ETF, and how's your approach to staking in such a vehicle?
Yeah, great questions. I do think there is a portion of the traditional financial audience that finds Ethereum easier to understand because it has cash flow and you can model it almost using DCF, right? It has cash flow and buybacks. And also because they're good analogies, right? Apple has an app store and it makes money on people using the apps in the app store. Ethereum has an app store and it makes money from people using the apps in the app store. That's more intuitive than let me tell you about a digital new version of money that you can't touch that exists in a cloud that's worth $70,000 per coin, right? Some people have a hard time getting their heads around that versus here's an application, you pay a fee to use it, and then the fee is what amounts to a stock buyback. That's a little bit easier. So I think it will have a real audience if we have time to tell that story from traditional investors. I still think it won't match the Bitcoin ETFs for flows, but I think there could be billions of flows into an Ethereum ETF, particularly as we see increased traction on the application side. So I think that's really important and really exciting. As far as Bitwise, of course, we're going to have an Ethereum ETF. We want to be the trusted partner in crypto for US financial professionals, and many of them will want an Ethereum ETF. So, of course, we're going to provide it to them. We're studying it closely. We're doing our correlation analysis, and I suspect that we'll file relatively soon if everything lines up the way I think it will. So we plan to be in the race. We plan to win our fair share, just like we have at Bitcoin. And we plan to spread the message about Ethereum to our audience, just like we're doing about Bitcoin. And you asked one more angle of the question, which I forgot now. Or did that cover it? Staking. Yeah. Obviously, you want your Ethereum ETF to stake. The way my experience with the SEC is what goes through is the minimum viable product, right?
Mhm.
So if you think about the Bitcoin
Makes sense.
ETFs, not to get too technical, but what went through was cash creations, not in-kind creations, because it was the simplest version of the product that they could intuit. And to be charitable to the SEC, which I like to do because they're my regulator, to be charitable to them, they want the simplest version because they don't know about the other risks. Can you tell me definitively that there's zero risk from staking, no matter how you set it up and who you use? Definitely not. There's some risks that you have to understand, and it's more complex. So my expectation is that the first Ethereum ETFs will not have staking in them, and that staking will be added in the future, just because it will take more time to get the SEC comfortable with how that will work. There's no reason you can't do it. It's just my experience is they like to crawl before they walk, before they run. And the crawling version of an Ethereum ETF is just Ethereum in a lockbox that sits there. So I wish I had a better answer that was like, yeah, they'll be staking for sure. But at least in the US, I think we'll crawl and then walk and eventually run.
Yeah. No, it's a very reasonable take, and it makes sense. Like, it's a process, it has to mature, and yeah, step by step, right?
Yeah.
You know,
Yeah.
it's like anything in life. And that's what I really appreciate, actually, is the way you've given us this really nice, simple way of explaining something that is actually incredibly complex. Because for people who I think we work in the space every single day, right? And we're so caught up in all of the jargon and the news that's coming out and this new protocol, hey, and they did that. We're really on top of it. We're like all academics in a way. But the way you explained it now with Ethereum as this is the app, and then we have all these guys building apps on it. And one of the let's call it developers building on the Ethereum app store is BlackRock. And another one is Franklin Templeton. And so now they've come out with these tokenized funds with treasuries on the back end, so they're money market funds. And as a result, they've actually now given investors a lot of the benefits that we know and love from the digital assets space and from blockchain. So 24/7, 365, always available. There's also opportunities with regards to custody, which is great. And I'm wondering now, with us now seeing this adoption and actually starting to do things on chain, continuing with the whole Ethereum discussion, they of course are tokenizing these funds with Ethereum, which means they have Ethereum balance sheet, and they're creating these assets by paying also with Ethereum. And in this process, who do you think are some of the losers from asset managers and fund providers actually moving on chain?
Great question. And I love this example, the Buildle Fund and what Franklin has done. One important thing, and then I'll answer who the losers are. It's so nice to see these built on public blockchains. If you
Bingo.
back up a cycle ago, this was built on Hyperledger or some private blockchain run by a few banks, and you knew it was a doomed proof of concept product that was going to be a headline and then nothing. It's
Yeah.
really an indication of how far we've come that we're now BlackRock's building on Ethereum, right? Think about those words. Those are three really cool words. And I think
Yeah.
that does say how far we've come. I hate to keep using these ETF analogies, but it is my background, so I'm going to. There were a bunch of asset managers who refused to launch ETFs, who said they were mutual fund shops and mutual funds were their bread and butter, and we're not doing this ETF thing. And over the period of 10 or 15 years, they became largely irrelevant. They've had zero flows, and eventually they all launched ETFs, right? Because it became the dominant way. And the early movers, which were not large asset managers, became dominant. So people don't remember this, but BlackRock didn't launch ETFs. They bought them from a group called Barclays Global Investors, which was like a minor asset manager that innovated in the space, became enormous, sold to BlackRock. Now it's the largest way people invest in the world. The same thing is going to happen here. The early adopters from traditional asset management who embrace the idea of tokenizing real world assets, making them available on chain to the growing sort of audience that loves to manage their wealth in a 24/7, 365 environment, they're going to establish leads that will compound over time. And the losers are going to be all the asset managers who are either ignoring this or building on private blockchains because they feel more comfortable. And I don't want to name names, but you could probably find some US financial institutions who fit in those two categories. And conversely, the people who build early will be huge winners. I would add that there will also be non-traditional asset managers, crypto native asset managers who embrace this trend and become just as large as anyone else. Right. And that's certainly what you saw in ETF land. They're ETF native managers, if you can use those words, who became enormous and they got bought out in the end. But the same thing will happen here. And I love, as much as I love to see what BlackRock is doing, I love to see what Ondo Finance is doing. And I find them equally interesting and equally building. But yeah, people who are late to it, who are ignoring it, they're going to miss the boat. And kudos to BlackRock, we should say. 6 years ago, Larry Fink called Bitcoin an index of money laundering. And then he studied more and learned more and reversed position. And now they have a leadership position. We compete with them, but kudos to them.
No, that's true. That's very true. I just wanted to just try and sneak this in. At the end of the day, when you tokenize something, it's not exactly living on chain. You're tokenizing the contract. So even though it's money market fund and the users are holding tokens, in the back end, it's actually still just traditional treasuries that are sitting there. So, how do we have this amalgamation? And when do we have everything sort of living together on chain, the seamless integration?
Yeah, that will take a lot of regulatory progress. I think, at least in the US, I don't know other markets as well as I know the US, but in the US, their regulatory restrictions and the sclerotic way that our regulatory system works, that until we change those things, it's not going to happen. In the US, we still have paper stock certificates that have to change hands at a obscure company called Seed and Company in the southern part of New York City. If you can believe it, that still happens. It'll be a while, but I think it's okay. You get some of the benefits as you merge these two things together. You get 24/7, 365 trading, you get marginability, you get faster settlement, you get lower fees. It's not perfect. Similarly, if you look at our Bitcoin ETF, we publish our Bitcoin addresses. That's not being on chain, but it's providing one of the benefits that you can have uniquely in this asset class that people don't have to rely on auditors. Of course, we have an auditor, but you don't have to rely on that. You can trust it yourself. So I think we're going to see these sort of combinations And eventually we'll get to a new market structure. But I think that will take regulatory legislative action, at least in the US. And the timeline for that is I'm not sure. So I love these baby steps. I think they're really important.
I loved your take on the tokenization part because we also monitored that a couple of years ago that everybody built on private blockchains. And now we see this huge pivot towards public blockchains. So it's definitely a thing. And currently the most dominant ones range from Polygon, Stellar, some Solana or Centrifuge, which is a parachain in the Polkadot ecosystem. But now, interestingly, like the recent and one of the most major entrants was BlackRock now choosing Ethereum and basically choosing kind of lindiness / age, security and reliability over speed. What's your take here on where does that leave other smart contract platforms when it comes to tokenization and real world assets?
Yeah. As an investor, if I were investing in the concept of tokenization, I think it'd be foolhardy to bet on any one chain at this point. I just think it's too early. You're absolutely right. BlackRock went with the luxury brand, which is what Ethereum is in the layer one space. It's the expensive luxury Lindy brand that's been around for a while. And that's not surprising. It has a lot of great security guarantees and great developer activity and great reasons, and it's working on interesting solutions on scaling. I don't know how, I mean, this is a long-winded way of saying I don't know how it turns out. I find each of the different architectures that you mentioned uniquely interesting with benefits and risks. Solana's monolithic architecture gives it enormous speed at the expense of some centralization risk and some uptime risk. Is that going to be the killer app, or will it be a more Ethereum central chain layer 2 complex ecosystem? I just have no idea. I'd love to know what you guys know. I have no idea. So as an investor, my view would be, let's bet the field. Let's own them all, because I'm not smart enough to figure it out. But I'm sure there are people who are smart enough. I just am not one of them.
You outlined it very well. It's at the current point in time, it's just unclear. And we have the properties ranging from lindiness, security, basically age, decentralization. There are a lot of metrics to look at. Only time will tell us what was the right decision in hindsight, I guess.
Yeah. Fortunately, the trend is big enough that even if you're just approximately right, I think you'll do well as an investor. You don't have to.
Yeah, I guess there are some ecosystems where it's rather safe to bet on, which is, as we discussed, like Ethereum, Solana, or just bootstrapping your own rollup on Ethereum. Or now with the modular ecosystem, basically you can choose where you settle. You can choose where you get your data availability. You can also choose how you execute. With modularity, all of these entities get a huge chunk of design freedom. So it will be nice to see how that plays out, especially when it comes to technological advancements. Just in the recent months, so much stuff happened in the crypto space, ranging from privacy enhancing features to UX improvements to scaling solutions. CK proofs is a big thing. So there are so many moving blocks. Yeah, the conclusion is the same. It's hard to pick a winner, but I guess there are a couple where you can bet on. Yeah.
100%. Yeah, I think this is a prime area for research on the smart beta or fundamental indexing side too, because I bet there are, even if the only result of those indexes were to avoid a couple of obvious losers, right? Even if you couldn't pick the winner, but you could say these ones clearly are not growing in any fundamental sense. I think that would be an enormous, people forget the value of negative screens, but it's almost better than positive screens as an investor.
Yeah, very great take, because there you can certainly rule out a good amount of ecosystems that sustainably did not show any traction or momentum. And with on-chain analytics, you can measure so many metrics ranging from active addresses to TVL to fees captured.
Yeah, absolutely. For me, it's more a question of looking now into how much data we have on chain and just following like the structure that we have now. If you look at interest rates, and specifically those from the Fed, interest rates currently are pretty high at like 5.3% roughly, and that is actually considered risk-free. Okay. And but when you start to adjust for inflation, you start to see that it's roughly around 2.1%. And so if you are somebody like BlackRock, any one of the major institutions, and you want to stay ahead of what's going on in the crypto market, you most probably are doing something on chain. It might not be public and for clients to invest in, but you must be tinkering around to know what's really happening. So, you're looking at the environment and then you're saying, okay, we have 3.4% Ethereum staking. And then if you look at the lending space within crypto, everything is 100% collateralized. And if I go about doing a lending transaction and I've got Ethereum and I'm investing in Ethereum, what's the risk then if I put out a lending position at a very favorable interest rate, higher than that of let's say the 2.1%? That's become something very attractive for me. And then how do I now as an institution start to view the space if I start to think maybe 10 years ahead or even now, to be more active and to start exploring and to be investing? There's definitely some sort of shift towards there being this market opportunity in crypto on chain versus looking at the traditional space with government bonds as an example. How do you feel about this?
I absolutely agree with that. And I do think it's increasingly attractive. The thing about the space that's so attractive from an institutional investor setting is you can over earn, in my view, from those sorts of transactions, right? Like the rates you can earn do not match up with the realized risk that you're taking on. And the reason you can over earn, in my view, there are two reasons. One is it's capital constrained because many of the largest institutions simply won't play in this space. There's not enough capital. So if you have capital to provide, you can over earn as a result. And secondarily, the crypto native due diligence is such an early field, and many of these institutions are unable to apply crypto native due diligence, which causes them to widen out the bands at which they're willing to operate. And so for an institution who's willing to dig in, um, alpha is the most challenging thing to find in the world, right? Because markets are extremely efficient. But there are these two right now, they won't be there forever, but there are these two inefficiencies in terms of capital constraint and due diligence challenges that if you're willing to jump over them, you can over earn in this space. And so I do think there are a lot of institutions that are looking at it, particularly now for those reasons. And then eventually we'll be interested in it because of the sustained higher rates you can earn in a normalized economy. But for right now, it's not even normalized. There's this excess alpha that you can gain by providing capital into the space. And you're seeing the largest hedge funds in the world, you're seeing the institutional desks at major banks, and you're seeing firms, I'm sure like BlackRock and others, hiring aggressively into the space to figure that out. I don't think you'll be able to over earn forever, but you can over earn for a period of time.
When we used to have zero interest rates in the past, there was an interesting saying going around that we were having free risk rates, not risk-free rates, because there's always risk, right?
I love that.
Yeah, that was an interesting. Sorry, I just had to plug that.
Yeah.
So true. That's funny.
Good one. I feel like with Ethereum, for example, having this deflationary cash flow asset and framing it like as soon as there's more awareness and understanding of this technology and that you actually have sound buybacks and that deflationary aspect is not just a meme, we will maybe see a narrative rising such as the on-chain risk-free rate or the internet bond or something like that. I wanted to touch base on something that you recently outlined, I think on Twitter. And we all know crypto is a very cyclic asset class, but with the ETFs now, a lot of the dynamics are changing. And maybe this bull market will be different when we look at previous bull markets, especially referring to basically the Bitcoin season, following up by the ETH season, and then followed and basically introducing the end of most bull markets with the altcoin season. And you framed it as the everything season because a lot of funds that flow from the new institutional money flow into the ETFs. But also there's still the wealth effect on the crypto native side that basically boosts the altcoins, basically resulting is in a everything season. And I really like the concept, and maybe you could elaborate a little bit more on the idea behind it.
Well, thank you. Yeah, I think that is what we're going to see. If you think about it like a bucket, historically, the way, ETH season and alt season has worked is the Bitcoin bucket fills up with wealth. People make money there. And then money starts to leak out as you get a wealth effect. People look for riskier investments. Same thing we see in stocks. Large caps tend to rally and respond first, and then we move on to more risky investments down the scheme. So same thing. And then after the ETH bucket is relatively full, that wealth starts to move into altcoins and then eventually into status symbols like NFTs. And, that's a cycle that makes sense and I think will repeat. But as you mentioned, the difference here is now we have a huge amount of non-crypto money flowing into the top of that bucket, right? It's not a captive economy. There's new inflows and they're massive. That just means that even if we have a wealth effect within crypto wealth of moving from Bitcoin to ETH to altcoins, we have so much money coming in that you can still have a Bitcoin season, even as you're having an ETH season, and even as you're having an altcoin season. So I do think we could have this everything season where you see something you haven't seen in the past, which is continual rallies in the large cap assets, even as the small cap assets rally too. Now, importantly, I don't want to be exclusively bullish. There's also the bear market season. And I'm not foolish enough to think that we've escaped bear markets forever. I don't think it's a super cycle. I think there will be pullbacks eventually. But I do think it's not going to be a traditional alt season. It's going to be, yeah, as mentioned, this everything season because we have this new wealth coming in.
Some people call it the everything bubble. No, but it's
Yep.
true. I have my own theses about this, and I would love to talk to you for like hours. We should do this
We'll
sometime.
do it again. Yeah.
Last but not least, from my side, following the Bitcoin and Ethereum ETF, what is your next likely candidate for an ETF and why? And then what are your 3 hot takes for 2024? Can be bold.
Wow. Okay. In the US, it's going to be a while till we get anything besides Bitcoin and ETH and a combination, because you need to have a regulated futures market before you can get a spot ETF, and there's no regulated Solana market. So I suspect it'll actually be a lot of assets all at once after we get some sort of legislative change. So I don't think it'll be onesie twosies. So there's my thought on that. And that'll include index funds, and that will make me very happy. So we'll get there. Takes for 2024. Let's see. What are some of my takes for 2024 being bold? I'll give you the Bitcoin price prediction, which people always want, which is I think Bitcoin's going to punch above $100,000. And above that, I think it's very hard to set any price target. My view of what's causing Bitcoin's price movement right now is you have new net buyers through the ETF and you have natural sellers through miners. And of course, with the halving, those natural sellers will come down. And as long as there's more demand from the ETFs than natural sellers from miners, you have to have people who have Bitcoin be willing to sell. It's not surprising to me that some people were willing to sell at $70,000, our all-time high. So we're going to chop here for a while. It's not surprising to me from a behavioral perspective if some people will be willing to sell at $100,000. I suspect there'll be a sell wall there. The challenging thing to setting price targets is if we get through that, where does it stop? Where is the next behavioral sell line? And I don't think there's a clear answer to that. So if I'm right and that ETF demand continues, I think we could punch above $100,000, and then I don't know how high it goes. So that's my view, north of 100K. Let's see, other hot takes. I think people have been distracted by the Bitcoin ETF and failed to internalize how important the Denkun upgrade is on Ethereum. And that is going to lead to a flowering of 1 million real-world use applications, and that we will see launch this year the first crypto native app that has consistently 1 million plus monthly active users. And it will take advantage of consistently low fee targets and throughput on Ethereum. So I think we'll see 1 million monthly active users on one crypto app consistently, not as a bubble, but consistently. That'll be launched this year. Let me see if there's any other hot takes. Yeah, I don't think this is a hot take because this is too popular, but I do think DPIN is going to have its moment and it's going to get extended beyond the fundamentals. So by that, I mean, I think there'll be a DPIN bubble. I think DPIN is real. I think some of the projects are really interesting. I just think it has all the markings of something that will get overhyped and allow the price to exceed the fundamentals. So I think investors should look at DPIN. I think it's an interesting space to allocate to, but I would also remember a rebalancing tolerance, because it has the markers to me of something that can create mimetic bubble-like activity and both run up and then pull back significantly.
Great. I
Yeah.
agree with all of these takes, to be honest. Thanks for sharing your time and knowledge with us. It's really highly appreciated. And for the audience, if you're not familiar yet, Bitwise has insanely good research content. Check their website, follow Matt on Twitter. He has really great takes.
Thank you so much. Thanks for having me.
Thank you, Matt. It's a pleasure.